In 2018, Dr. Sonal Desai became the first woman Chief Investment Officer in Franklin Templeton's history. As Executive Vice President and Chief Investment Officer for Franklin Templeton Fixed Income, she oversees north of $130 billion in assets. Dr. Desai is a member of Franklin Resources Executive Committee, and that's a small group of the company's top leaders responsible for shaping the firm's overall strategy. But here's what I'm most taken by. She's been named to Barron's annual list of the 100 most influential women in US finance every year since the list was introduced in 2020. Ladies and gentlemen, every single year. In conversation with her today is Rahul Goswami. You've met him. He's Chief Investment Officer and Managing Director, Fixed Income India at Franklin Templeton Asset Management. Dr. Desai, Rahul, welcome. Well, we're looking forward to this conversation, so it's going to be steered by Rahul. Over to you.
Yeah, good evening, friends. And after highly inspiring, hearing stories of highly inspiring women, and we have yet another one, which is Dr. Sonal Desai, who has been the first women CIO from fixed income from Franklin Templeton, US, and she has appeared in the last 5 years on the top 100 influential women's list in financial sector. So, welcome Sonal, and thanks a lot for taking time out to visit India. And can you just take us through about your journey to reach where you have, and all through in Franklin Templeton, and from economist role and then to a fund manager and to research and everything?
First of all, I have to say, you're asking me about my journey and I'm embarrassed to even talk right now. Honestly, this is on a day where we have seen so many absolutely inspiring women come to this, starting this morning, and we've just been continuing. Dr. Ravi was shockingly good. we have just followed that up with such fantastic stories. For me, I would say that the journey has been interesting. In my career, I worked in academia. That's where I started. I spent a couple of years as a professor in the US after I did my PhD. After that, I worked at the International Monetary Fund, so that's basically the government sector. And then I moved on to the private sector. I've been at Franklin now since 2009. And I have to say, for me, it's been a great thing. I realized a long time ago, I used to say that what I did was economics, and now I actually realize I am an economist. That's how I think.
Okay, thank you. So you have been born and brought up in India. You had your undergraduation or probably post-graduation also in India. How the India you have seen over the years, and you have been to India pretty often. So what's the change that you see? How the parivartan that has been witnessed in the last 20 years?
Oh my goodness. The parivartan in the last 20 years, it's been transformational. But I think what I grew up in Delhi, and I did my undergraduate degree at LSR. And after that, I went to the US after doing a year at Delhi School of Economics. I went to the US after that to do my PhD. And I think, honestly, it has been transformational much since 2000. Of course, things have changed. But truly, in the last few years, there has been an acceleration of the move, which has been fantastic to see. I was just joking during the break that people have always said India is sleeping. It's always been on the cusp. But I think this time it's really achieving breakthrough speed. And that's extremely exciting to watch.
Thank you. So probably about, say, 5 months back, you wrote a quote that Fed fights inflation and market fights the Fed. And that has typically been coming true. And what is the situation you see, or how things you see, panning out next, say, 6 to 8 quarters as far as inflation and interest rates in US is concerned?
So, it's been quite a long time that I've been thinking on the inflation front. So, we've been much before, I would say, markets on this. A couple of years ago, I still remember we were talking about how Fed funds would need to be above 4%. We were talking about how US Treasuries would need to be significantly higher than they were at that time, which was between 2 and 3%. That seems like a very long time ago, but it wasn't that long ago. I think the path for the Fed is a very difficult one as we go forward. And furthermore, I think the market is still actually somewhat optimistic in its hopes that we're going to get a quite quick reversal of all the rate increases which have happened so far. Personally, I feel we will be lucky if we get 50 basis points of cuts next year, and it would only happen in the second half of next year. Even to get those rate cuts, we are going to need to see unemployment actually pick up substantially from where we are right now. And this is, of course, it's not going to be very welcome news necessarily, certainly for fixed income markets. But I tend to think that actually we might be getting to a point of a much healthier market than we have actually observed in the last 15 years, where markets were driven very much by central bank policy action, in the sense of bailing us out constantly.
So what I understand is that you're saying that the rates are, even if, say, a rate cut of 50 basis point, if it has to happen, it will be second half of calendar year 24. And nothing earlier looks pretty likely at this point of time. Then do you think that Fed will be probably more or less done on the rate hikes is concerned, or you think that there is much more to go as far as Fed rate hikes are concerned?
So, we've got to think a little bit, because people have a view that the Fed is going to drive the economy into recession, that, monetary policy is very tight. And I'm going to say something right now. Monetary policy is actually not that tight. It sounds strange because, we have rates sitting currently at 525 to 550, and the Fed has had a very accelerated run of rate hikes. But monetary policy in the US is actually not very tight. Let me explain, because when the Fed talks about its neutral rate over the medium term, it's still looking at a rate of something like 2.5%. If you think about how that 2.5% comes together, it is a combination of 2% inflation and 50 basis points only of positive real rates. But this 50 basis point real rate has only been the norm since the global financial crisis. So basically in the last 15 years, until COVID, and then it was also very, very low. But from the 1950s until 2007-8, the average was about 2 to 2.5%. So if I take 2% inflation, which is optimistic, and I put in that pre-GFC real rate, the neutral Fed funds rate is around 4.25. And then you have to add term premium, which means that your long-term yields actually are going to be even higher. This is a roundabout way of saying that should the Fed be raising more, if inflation doesn't come down, maybe in November they will raise more. But the bigger question right now is not what peak Fed funds is. To me, it is how long does it stay there? And that is, to me, the real question. And I think it's going to be for a longer time than people are anticipating right now.
So we have been reading various articles where some of the guys are advocating that probably it's one of the good times to lock into duration, and so you think one should aggressively add duration, or these if the risk reward you think is attractive enough, or should we wait for the real rates, or the rates on the longer end of the curve goes higher?
So actually I'd say that we do think, right now we're looking at 10-year yields of around 425,
Yeah.
or 430, I don't know what today's rate is. We're looking at rates of around that level. And I do think there's upside, as I just noted, there is the potential to have upside pressure on the long end of the yield curve. In our strategies globally, our global strategies, typically we were short duration. As duration sold off to the current levels, we have moved our position to neutral. We are not yet going all out long duration. We will, but the reasons we are not going outright long automatically is we have been talking a lot about monetary policy, and I think we need to also actually talk about fiscal policy. Fiscal policy is a very big deal in the sense that last year we had a fiscal deficit of about $1 trillion in the US. That's a lot. This year, despite the fact that unemployment is close to 40-year lows, it's not at the 40-year lows, but very close to that. It's at around, we are looking at unemployment of around 3.6, 3.8% in the US. Despite having actually a very robust labor market, the fiscal deficit is likely to go from 1 trillion to 2 trillion this year. We will likely end this year with a fiscal deficit of above 7% of GDP. So let's just stop and think about that for a minute. Above 7% of GDP, over and above that, because there was the debt issue, the debt ceiling issue earlier this year, the Treasury did not issue debt for a long period of time. And so now in a concentrated period of time, there's going to be a massive issuance of debt. And this has already started. So I look at these factors on the fiscal side, and I do think that, you're going to get that upward pressure on yields coming from this.
Yeah, so what I understand is it is a combination of high fiscal deficit that has panned out in US for this year and the next year for FY24, which is October 23 to now September of 24, that fiscal deficit is likely again to continue at close to 7%. So it's slightly elevated inflation and, healthy labor market conditions and, not a subpar growth. So all these three conditions combined, basically you believe that rates are more likely to stay elevated next, say, 2 to 3 quarters.
I think that's, yes, and we haven't actually got to all of the, all of the reasons, because we haven't yet talked about what I would consider technical factors. Number one, last year, the Fed bought the entire issuance of the federal government. The Fed has stopped. So the entire demand from the Fed, which was everything that the federal government issued last year, that has gone away. Number two, I look at Japan. Japan now actually has genuine inflation. In the coming few months, we are likely to see another technical factor coming into play, and that is that we're going to have Japan, probably Japanese investors, beginning to repatriate some of their own holdings of treasuries. Everyone thinks China is the largest holder of US treasuries. It's not, it's Japan. And so you continue to see this, we are likely to see this additional pressure coming from the long end. And there are still other factors, but I could go on this for a while because there are other factors as well, which I think over the medium term, let me digress for a minute, Rahul. Over the last 15 years, there was this it was very fashionable to talk about secular stagnation, right?
Yep.
The idea that inevitably the developed world was moving towards low interest rates. The biggest threat on the horizon was deflation. Demographics were going to make this happen. We didn't buy it then. We certainly don't buy it now. In fact, there are now secular factors which are going to be supportive of rising long-term yields because they are inflationary. And I can go into those, we can talk more on that.
How do you see, basically, so like say if US remains on elevated rates and inflation also remains on slightly elevated range in US and probably other developed market economies. So do you see that it is a worldwide phenomena that is going to happen, like say it is going to spread to the emerging market economies, or this will probably be contained with developed markets only.
So, when you have a situation like this, if I am talking about emerging markets as a full group, yes, it's actually quite negative typically. So we have seen, in fact, consistent outflows from emerging market debt over the past several months now. We have seen outflows from EM debt. I would note that there are two countries which typically sidestep some of these global factors. One is China and the other is India. There is a reason these are two very large economies which tend to be more driven by domestic factors. Now, a lot of the factors which are going to impact US treasuries actually are going to have some of the impact also on inflation and, importantly, the rupee here in India, one of them being the price of oil, which we've heard from several speakers already, so I won't belabor the point. But clearly that is different. So that would have an impact. But just by virtue of the Fed raising rates, supposing you see the Fed raising rates and oil prices, magic happens and they collapse. Actually, India doesn't get impacted that much. When we think about the taper tantrum, which was our last experiment, emerging markets as a whole suffered. India did not suffer so much from just the taper tantrum. And I think this is something important to keep in mind. It's not automatic. Undoubtedly, in part, I'm talking about government bonds here. There's a different dynamic at play if we're thinking about dollar-denominated corporate debt. But if I'm talking about government debt, there's essentially very little government debt, if any, that is held percentage-wise by foreigners. So it's a very different situation.
So you mentioned about, say, Japan. So what we have seen is Japan is also now realizing that, or the Bank of Japan is now gradually realizing that the war on inflation has to be fought with much, more on the front foot rather than staying back. So, and whereas they've kept the interest rate zero last 20 years. So do you think that Bank of Japan rate action movement can trigger, some, global turmoil as far as the bond markets are concerned and its impact probably on the emerging markets?
I think no. When Japan finally changes its overall policy, remember it's 30 years we're talking about deflation in Japan. The change, the paradigm shift in Japan as inflation actually picks up, it is dramatic. And yes, the Japanese yen carry trade has for decades actually funded a lot of the trades around the world. So absolutely, as this changes, there is going to be an impact. But it's not only going to be on emerging markets, it's going to be a much broader felt impact, like I mentioned, including in the developed world. Because the Japanese investors, for the longest time now, have been sending their money abroad. And they will be bringing it back when this happens.
Okay. So probably in, say, April, we saw, bank collapses, regional bank collapses in US.
No, you need to hold it closer, I think, Rahul.
Sorry. Yeah.
Even I can't hear you.
Okay, sorry. Yeah, so we saw a few bank failures in US and Europe. And ultimately that corporate debt outstanding in US is also pretty elevated levels. So, which is double the absolute dollar value is almost double what it was, say, pre-GFC. But yeah, we have passed 15 years after GFC. So, where do you see this problem of, systemic failure or systemically becoming problem as far as in US or Europe is concerned on banks?
On banks. So, I think that SVB and the problems with SVB, to some extent, I think were misunderstood, right? This is not a Lehman moment. It's very easy to look at SVB and say, banking problems, interest rates went up. This is just like another situation where we have a contagious crisis developing because the Fed is raising interest rates. The massive difference is that what SVB had on its books were the world's safest assets. They had treasuries. They hadn't made bad loans. One of the issues during the global financial crisis that had occurred was that you couldn't price securities. There were a lot of securities being priced off models. you give me a time of the day when you can't get a treasury price. You can price this, it's transparent, it is commoditized. We knew exactly what was inside SVB's books. Now, that was a failure of regulation. The US Congress has responded by new capital requirements. Quite frankly, it makes no difference because the existing capital requirements would have been fine if the bank had actually been regulated with them. They weren't doing, the San Francisco Fed, which regulates SVB, was clearly not monitoring what SVB had on its books. So it wasn't contagious. We didn't think it would be contagious. It wasn't contagious. The next thing which always comes up is what about commercial real estate? Commercial real estate will have impact on certain regional banks. What I mean by this is more than 50% of the US banking system sits in the hands of majors. The majors don't have much exposure. I'm talking about the JP Morgans, the Citibanks, and so on. They don't have much exposure to commercial real estate. Commercial real estate is in the hands of regional banks. And this is where it gets interesting because the regions are not homogeneous. Absolutely, San Francisco is a mess, so is New York, to some extent Chicago. There are several large cities, Los Angeles, where definitely you have problems with commercial real estate, and those regional banks are going to have some problems. However, there are other parts of the country, Houston, Dallas, which, have had population inflows, where in fact, if you're a regional bank and you have lent to such commercial real estate, you're going to be fine. So again, it's difficult for me to see this as being a trigger for a truly contagious crisis by itself. You need something else as well, is what I'm saying.
So post-COVID, we saw basically China closing down their economy or having a zero-COVID policy for almost more than 2.5 years, from middle of 2020 to end of 22. That led to discussions around China plus one strategy. And we have seen quite a lot of enthusiasm and excitement building around India manufacturing. Do you see this time it is a different strategy, and what are your views on that?
So, this is a really interesting question because people tend to focus on the post-COVID period. The reality is the tensions in particular between the US and China started a long time before COVID. They started already with President Trump. In the US, the Republicans and the Democrats agree on nothing except neither set are very fond of China. So, I would say that this is the one area that there is very little debate within the US in terms of what to do. And the process of, you can call it deglobalization. I personally call it, it's not deglobalization, but it is nearshoring, friendshoring, till we come to a point where we are today, where Mexico is now a larger trading partner for the US than China. So this is a big move. I do think that this is happening, and I don't think it's changing. But the biggest impact of doing this is that it's going to be inflationary, because what we have to recognize is there was a reason that all these companies moved to China in the first place. It was cheaper. Now we start moving to different countries, it's actually going to be more expensive, and eventually the cost structure will result in higher prices globally. That's one thing. And actually, just on this, let me raise another one. We all recognize climate change is front and center in people's minds, but there has been little acknowledgement of the other side of climate change, which is, greenflation. It is expensive. I repeat, all of this requires massive capex. Transforming economies requires massive capex. The somewhat ironically named law, the Inflation Reduction Act, was a massive capex spend on green projects, but it has in fact resulted, to some extent, it has contributed to the greater fiscal deficit and the probable continued support for inflation. Again, these are things which we need to keep in mind when we think about those secular trends I was talking about. And one of the reasons that I don't see deflation as the inevitable outlook for the developed world.
So you cover from US many countries. So if you can share your views about, say, China and Korea, which typically has some impact as far as the direction of the economy going for India also as well.
So no, I think India is clearly a beneficiary, right? India is a beneficiary of this move,
Yeah.
without a doubt. I think for India, the things we are doing completely right are the fact this focus on infra is very, very important. I think there needs to be additional focus on making sure that we have enough trained workers for companies such as the Foxcoms of the world to allow Apple to actually scale up in a country like India. We need to make sure that we have that skilled labor force, which isn't necessarily, by the way, a college-educated labor force, but an advanced vocationally trained labor force, and we continue in our process of increasing the infrastructure spend. Everything the government is doing in this direction right now, it's exactly in the right direction.
Thanks, Sonal. Thanks, Sonal. And see, we have seen some debates happening in last few quarters that there is possibility of deglobalization, and China promoting trades in CNY, and India trying to promote trades in INR. So recently, India and UAE have basically declared that UAE may start trading in INR against Indian on trades with India. Do you see any, situation emerging, like say dollar losing its value, or other countries, like say India or for China, basically trades getting more settled in their respective local currencies?
So the question is really, China started this move of doing its trade in renminbi some while ago. And everyone thought that, okay, this is the beginning of the end of the dollar as a reserve currency. I've never bought this, and let me explain to you why in a few minutes. And now India is also talking about trading in the INR. So I don't know how many people in the audience will remember. My father worked for the Defense Ministry when I was growing up. And at that time, with the Soviet Union, India used to trade in something called convertible rubles. What that meant was basically we bought defense equipment from Russia, and we paid them in rubles. Now, where did we get the rubles? Essentially, we would sell them what we had, which at that time, was largely things which were not industrial, but, everything from tea to commodities and things like that. But keep in mind, that did not mean that the ruble was what we call a hard currency. It was a trade agreement between two countries. China started this process some time ago, where they started doing more of their trade with other emerging markets like Brazil, using renminbi. But this is a trade transaction. Brazil is selling soybeans to China. The price of the soybeans are still denominated in dollars, and then you use the exchange rate to convert them to renminbi to figure out how many renminbi you get and you sell, yeah? Does this mean it is now a new reserve currency? Well, honestly, not. Because ultimately, the reserve currency doesn't depend on the current account, it depends on the capital account. We do not have full capital account convertibility. Neither does China. The US continues to be the deepest, most liquid treasury market in the world. Why is this important? I describe it in the following way. You take $1 to the smallest village in Africa, and you can leave $1 for someone as a tip. That guy can take it to a local money changer. Money changer can take it to a commercial bank, who can take it to their central bank, or themselves they can buy a US treasury sitting where they are. You can't do that outside China. You can't do that outside India. That's the trick. Once we get to a stage where you have convertibility, and then separately you have, in the case of China, certainly dependable institutions, institutions which you can recognize will always conduct policy a certain way, we might be closer. But right now, I would say no. The dollar can depreciate, but it's gone through cycles, again, for decades. It doesn't change.
on, so, we had a...
Can't hear you.
Yeah.
Can everybody else hear him? I can't hear you. Rahul, I really
Yeah,
can't hear
okay.
you.
Sorry. So we still find very limited women taking participation in the financial decision making in the family. And the same is reflected in the number of women participation in mutual fund distribution business. And probably not just in the mutual fund distribution business, but also in the financial markets, be it on the fund management side, on the research side. But how do you envisage, or how do you see an industry bringing up more women participation in the business of money?
Oh, okay, first of all, the problem I would say is perhaps worse here, but it's universal because it's also very bad in other countries. In the US, it's very bad. Women's participation is low. So I'm going to turn it around. We already heard one thing today saying, it is the culture, but I'm looking at all of you. All of you, you have sisters, you have daughters, you have mothers, you have wives. Encourage them to be in the workforce. Encourage them to come out and give them the support that they need, because it is true what we heard this morning. Women spend a lot more time taking care of parents, children, all of these different things, and they need more support. And I would say that's how we do it. It takes a village, right? And definitely, I think that everybody in this audience, I would challenge them to go out and do exactly that. Encourage their daughters, sisters, wives, mothers to go out and do this, because it is an excellent idea for women to be taking these decisions, becoming financially literate, of course, but also being a part of our industry. I think that kind of diversity brings interestingly different decision-making capacity. So that's what I would say. I feel very passionately about this, and I would always say that I'm not happy about what we have in Franklin, but we can only try to do better, right?
So you said you're managing about $140 billion globally. So, but that's a pretty stressful job and would keep you awake all night, all day. But how do you unwind in your downtime, and what are the other hobbies or passions you? It was mentioned that you have hobby on the baking side and you have done a course on the baking side. So you want to take us through that?
So, what I did was, on the baking side, I actually got a professional degree in patisserie for various reasons. I had 6 months where I had accumulated leave and I was forced to take it when I was leaving the IMF. So I took an accelerated course at the Cordon Bleu, and I did a 1-year professional baking course in 6 months, which is because they wouldn't let me take a different job. So, when I started working in finance, and I would always tell my boss, I'm slumming it. I could have been a pastry chef. I didn't have to be here. But today, actually, I continue to like to cook. I love gardening. I love reading. So it's mostly things which calm me down after a day in the markets.
So on the financial market side, we have many, investors who keep asking what data to track. Sorry, I'm debating. So what data to track on US economy from rates perspective from India? Like say you have, expert team on the US research, but if you can just highlight 3 or 4 data points which one should track more keenly, more actively, so that he's better aware of what to plan, what not to, what is.
I think actually, it's been a long time that we have not tracked the deficit. We should start, right? It's clearly an issue. We need to start tracking the deficit. I think most people are tracking wages. These are the things to look at. And underlying core inflation, these are standard things. These are standard things which actually make a lot of sense to continue to track, I would say.
What would be your closing comments, if you can just share with the audience, please?
Most of all, I would say thank you all. We value our partnership and the support you've shown us through these last several years, some of which have been very difficult. We understand. I cannot tell you enough and thank you enough how much we appreciate everything you do with us here in India. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.